Hello. Today I'm going to use EO Consulting's new schools benchmarking tool to investigate the value for money of supply teacher insurance cover. I'm going to start with Aldrington School for no other reason than I am a governor there, and benchmark it against the cluster of schools that it works closest sharing resources with, and then see if there are any wider policy issues that should be further explored from the analysis. From EO's regional CFR dashboard for the South East and South London, I'm going to go to the School Comparison tab, input Aldrington, and then look for their cluster group, which happens to be all the Church of England schools in Brighton and Hove, plus one other C of E school just outside the LA boundary, St Nicholas and St Mary's. Moving to the actual income versus expenditure tab, you can see that the school choices have automatically flowed through, with Aldrington in blue on the left, the comparator school cluster in tawny orange on the right, and in the middle the regional average. We are going to analyse totals over the last 3 years. First we have to select the relevant insurance categories, in this instance E10, Supply Teacher Insurance, and I10, Receipts from Supply Teacher Insurance Claims. This will need to be done for all 3 columns. Looking at the results for Aldrington, we can see that over the last 3 years the cost of supply teacher insurance has been just over 19k, while the insurance payout has been just under 15k, a loss of £4,200. The average loss across the 9 schools cluster that Aldrington is part of is of similar scale, while the loss across the South East and South London region is about double. Interestingly, the average loss across the local authority, Brighton and Hove, is over 3 times that of Aldrington and the cluster group. In short, it would appear to pay to self-insure. Of course, one of the reasons why you have insurance is to smooth the cost so you are not faced with having to in-year reallocate your budget at the expense of vital services. We can see that the insurance only paid out in one of the 3 years, 2016. So if Aldrington was to self-insure, the maximum it would have needed to fund in year was 6.7k, or just over 0.5% of its budget, not an insurmountable sum to find for a 2FE school. And if we quickly skip to the School Trend Overview tab, you can see that Aldrington in year has the surplus to absorb such a hit without impacting on other services. We have undertaken this analysis using EO's standard CFR dashboards, but given the evidence that there may well be a misallocation of resources, we have created a separate teacher supply insurance dashboard using data from the last 8 years. 8 years because this roughly coincides with the impact the insurance cycle has on premiums. First I'm going to check whether the self-insurance recommendation has changed for both Aldrington and the cluster over the longer period of time. In Aldrington's case the saving would be 25k over the 8 years, with payouts only happening in 2 of the 8 years, and as seen before, 2016 being the biggest call on any contingency. If we move to the Data Table tab and analyse the 9 schools cluster, we can see that over the last 8 years, only 3 out of the 9 schools receive payouts greater than premiums, and the average annual school loss is only £552. The peak annual payout is £18,000, which would mean that each school would only have to ring-fence £2,000 per year if a cluster were to pool its resources, against the average premium payment at present of circa £8,000. If we return and enlarge the data table, we can see those 6 schools that over the last 8 years would have been better off self-insuring. The question for me is whether there are any additional incentives for working together in a cluster to manage any systemic issues with regards to the likes of St Paul's, as it is clearly impacting how much money would need to be annually put aside. Whether the cluster decide to administrate this themselves or not, there are certainly some schools within the cluster, St Bart's and St Martin's for example, that the data suggest they should definitely think about self-insuring, as the incidence and sum of their payout over the last 5 years is tiny. So digging a bit deeper, our business manager informed me that they participated in the Brighton and Hove Council's sickness cover scheme, which is open to primary, nursery and special schools in the city and is run in-house. It claims to represent value for money and not to make a profit. Payment is through the local authority's service level agreement with the schools, and the impression given is that you can't opt out of it without undermining the value for money of the scheme for everyone else. So let's look at some of these claims. If we select Brighton and Hove and all primary, nursery and special schools, we can see that over the last 8 years, aggregated school supply staff insurance expenditure has exceeded receipts by £125k per annum, or £2,000 per school per year. But what is noticeable is that recently insurance costs have been on an upward trajectory. So let's just isolate for the last 5 years, and we can see that the total surplus over the period is 1.1 million. That's 221k per year, or 3,600 per school per year. Now let's be generous and assume it requires one dedicated official to manage the claims, costing an all-in salary of £50,000 per year, and it would appear that the LA is still making £170,000 profit per year. Now the figures within the CFR returns might also include some private insurance taken out by schools, but I expect this is proportionally a very low percentage and most probably related to non-teaching staff. So without Brighton and Hove proving otherwise by being totally transparent with their costings, it would appear, contrary to what is being claimed, that profit is being made to cross-subsidise other service provision. And this still does not overcome the value for money issue of self-insuring, especially if you have reserves and can operate in year with a healthy contingency. This does beg the question whether there are any national policy issues associated with the provision of supply teacher insurance. If we look at all the schools in the country, the annual cost over receipts is nearly £43 million, which translates to building around 7 new 2FE primary schools. We can see that there appears to be an inverse relationship between the number of children on free school meals and the size of the loss, ranging from a deficit of under £600 per school per annum for a high band FSM school to just over double that for a medium band school, to over 3 times that, or £1,900 for a low banded FSM school. This fits with the a priori assumption that the level of stress-induced sickness is likely to be higher teaching more deprived cohorts. What is interesting is that the cost of supply teacher insurance for high FSM schools has been coming down, medium FSM has been static, and low FSM has been on the rise, suggesting that there is a redistributional nature that supports local authorities, discouraging schools from unilaterally breaking free from authority-wide provision. If we compare regions, we can see that they all spend more than they receive. So let's click on the South East, where the aggregated deficit is greatest, and we can see that the range is significant, with Hampshire showing the largest deficit, but this being exaggerated by only having receipt data for the last 3 years. So let's isolate for this, and we can see that the average per annum deficit is nearly £7,500. Now I see that Hampshire also seem to run their own in-house absence scheme, and if the take-up of this is high, then again it would appear that this could also be a profit-making exercise, making the county council after admin costs over £3 million per year. If we go to London, we can see that significant differences exist between authorities. Looking at the extremes, Hackney and Hounslow, Hackney schools seem to be on average gaining from payouts, while the vast majority of Hounslow schools state they receive virtually no insurance receipts. Such outliers would appear to be down to scheme specifics and or difficulties subdividing data, for I can't believe that every school in Hounslow, for example, would be happy over the last 3 years paying nearly £16,000 per annum of insurance premiums while receiving nothing in return. Well, at least I'd hope that's the case. Let's finally look at the breakdown of incidences of those benefiting or not from supply staff insurance over the last 8 years. Of nearly 22,000 schools, 66% make a loss averaging nearly £4,000 a year. Nearly 24% benefit by an average of nearly 3k per year, while it appears up to 11% neither gain or lose, which probably means they are self-insuring. Last year 71% made a loss, with the number self-insuring falling 5% below the 8-year average. What is interesting is that last year, of 11,000 low-band FSM schools, less than 4% of them self-insured, or 21% gained from having insurance, while for the high-band FSM schools, 18% self-insured, while 32% gained from insurance. Intuitively this is perverse, as the payback is better for high FSM schools, but yet more seem to self-insure. Could that be that insurance might be less available to these schools, or the terms not attractive enough? Finally, I note that over the last 8 years, there have been 32,000 incidences when a school has benefited in year from taking out insurance, while this has only benefited 13,500 schools. This suggests that 38% of schools have not benefited from taking out supply staff insurance once in the last 8 years, and that there is lumpiness in those that do benefit, in effect increasing premiums for those that don't. So let's bring this all together and offer up some conclusions. First, for schools like Aldrington, which I opened this analysis with, it represents better value for money to self-insure, especially as budgets are getting tighter. Working in a cluster could also offer better value if there is a high level of operational interdependence. Local authorities could well be profiting from their schemes, and I question whether it is for individual schools to contribute to the cost of any redistributional burden, especially when there is a lack of transparency. Finally, with significant differences across local authorities, it might be appropriate for the DfE to look into whether schemes need standard terms. As ever, these conclusions are only as robust as the data, the analysis of which is made so much easier by using EO's dashboards to present CFR data in a much more analytical and conducive manner. If you'd like to know more about how to get access to your suite of dashboards, then please do contact us at info@eoconsult.com. Thanks for listening.